The narrative surrounding AI has been dominated by the giants, your foundational model builders, your chip makers.
Right.
But if you've been watching the charts, you know that the real volatility, the moves that grab headlines, often happen in the specialized corners of the market. And right now, one name is it's exploding. SoundHound AI, ticker SOUN.
It's the classic situation in tech investment. I mean, you have the large, steady capital players, and then you have these high beta names tied to a specific technological edge. SoundHound is absolutely in that second category.
For sure.
And when a stock like this delivers a decisive surge, we have to ask, is it just retail frenzy or is there something else? Is underlying institutional conviction finally showing up?
Exactly. We've been handed an analysis report that focuses entirely on this recent momentum, specifically the day where SOUN surged nearly 4%, closing strong right at the $11 mark.
A key psychological level.
And the report argues this isn't just noise, it's signaling a major reversal driven by a fundamental shift in how the market views specialized voice AI. Okay, let's unpack this.
Our mission today is pretty straightforward. We are serving as your guide through this highly bullish analysis. This movement is linked to what the report calls a massive voice AI catalyst that the broader market is only just now waking up to.
Right.
If this thesis holds, understanding why $11 was conquered is, well, it's essential for understanding the future of niche tech investment.
So let's start exactly where the analysis did, the technical breakout. We're zooming in on the price action around January 5th. And this move wasn't a gentle ascent. It was a violent swing that suggests significant capital commitment.
And that commitment showed up immediately. The report highlights that the first signal of conviction was the gap up at the open.
To $10.75.
Right, to $10.75.
A gap up like that, where the opening price is so much higher than the previous day's close, that's always a powerful technical indicator. It often reflects overnight news, or, I think more likely here, significant pre-market orders from large institutions.
It signals they're willing to pay a premium just to get in.
It reflects urgency.
Exactly, and the key is that the buying pressure didn't just vanish after the open. The stock tested an intraday high of $11.28. That shows the initial surge had follow-through.
But the most crucial part, the confirmation.
It came in the final minutes of trading. The stock held the psychological $11 line at the closing bell.
And even ticked up slightly after hours, right?
Yeah.
To $11.03.
It did. A small but significant detail.
So why is that $11 line so critical? I mean, it's a round number, sure.
Yeah.
But what does the analysis tell us about its history?
It's not just a round number. It's often a high-volume resistance zone from prior trading periods. So clearing a key psychological level like $11 after hitting resistance there, it's like breaching a dam.
Okay.
And what's fascinating here is how this ties back to the established support zone. The analysis report identifies $10.50 as a rock-solid floor.
So if $10.50 is the floor, and the stock is now trading comfortably above 11, what message does that send to the bears who are trying to push it down?
It's a complete technical validation. The bulls stepped in decisively to defend the line above $10.50, and by moving and holding above 11, they essentially signaled to the market that a major sentiment shift has occurred.
So institutions are buying the dips.
And are prepared to hold positions for what the report calls the next leg up.
Okay, so that technical validation tells us when the movement started. But the fundamentals tell us why it matters. Let's put the chart aside for a moment and look at the actual business metrics underpinning this surge. The analysis outlines three fundamental drivers.
Right, because when you have a massive technical breakout like this, it only sustains if there's real substance underneath. The strength of this bull case really lies in the commercialization of their technology.
Our first major driver is revenue acceleration. Analysis is emphatic on this point. This is past the hype phase. We are talking about genuine, double-digit, high-velocity growth.
A number is approximately 68% year over year in recent reports.
68%.
And we need to focus on the quality of that growth. It's not simply, license fees. The report highlights concrete, real-world application revenue streams from giants. We're seeing deals with Stellantis.
For their in-car voice commands.
For the next generation of them, yeah. And we're also seeing major quick-service restaurant chains adopting their AI for drive-through ordering.
Okay, let's focus on that restaurant example because that's really specific. What does AI restaurant ordering actually entail, and how does that translate into 68% growth?
It's all about operational efficiency. In a traditional drive-through, you've got ambient noise, poor microphone quality, customers speaking complex orders.
I want a number 3, but swap the fries for onion rings and make the soda a diet.
Exactly. A human often struggles with that complexity. It leads to errors, delays. The AI processes that instantly and accurately, which reduces staff overhead and dramatically increases throughput. That value proposition accuracy and speed is what drives these massive recurring commercial contracts.
That application revenue leads us directly to the second major driver, which the report calls the specialization moat. And this is where we have to confront the elephant in the room. If Google and OpenAI have billions to build generalized LLMs like GPT-4, why can't they just crush SoundHound?
This is the strategic crux of the analysis. A generalized large language model is amazing at generative tasks writing code, composing an article, summarizing a document.
Sure.
But they are not optimized for real-time, low-latency, intent-driven commands in highly specific, noisy, or difficult environments.
So if I ask GPT-4, change the air conditioning to 70 degrees, it might give me an article about HVAC systems.
Right.
Whereas SoundHound's model, embedded in a Stellantis vehicle, just knows it's a command and does it.
Precisely. The system is designed around speech-to-meaning recognition, not broad pattern recognition. It immediately filters input for command intent within a defined domain.
The car's systems, the restaurant's menu.
Exactly. That level of specialization requires a deep, custom layer of optimization that the generalized LLMs just don't possess. Or, frankly, prioritize building. That specialization is the moat.
I hear moat, and I love the concept, but isn't this really just a massive head start? I mean, if the commercial demand is truly as big as 68% revenue growth suggests, couldn't a big tech player just decide to build the same specialization suite in, say, 18 to 24 months and bundle it for free?
That is the most critical counterargument facing any niche AI player, and the analysis suggests two answers to that. First, the time to market and the verification required for commercial contracts, like passing strict automotive safety and integration standards, it's long and it's arduous.
Right.
And second, the contracts they secure are sticky. Once a massive auto manufacturer integrates your voice AI across an entire vehicle line, replacing it incurs massive costs and risks.
So the specialization doesn't just block competition.
That locks in revenue for years.
That makes the argument much stronger. It's about market penetration and contract stickiness, not just better tech. All right, driver 3. This shifts back to market mechanics, and this is where it gets volatile. Short squeeze potential. The analysis notes that short interest in SOU is frequently hovering above the 15% mark.
A short interest ratio, that high meaning over 15% of the tradable shares are borrowed and sold, betting on a price decline, it indicates a fiercely polarized market.
A lot of people are betting against it.
It's a massive bet that if the company hiccups, the fall will be brutal.
Because there are so many investors betting against the stock, any positive news creates, well, a positive feedback loop, right?
That's the nonlinear effect of a potential squeeze. When fundamental buyers step in, maybe spurred by that 68% revenue growth, those short sellers are forced to cover their positions, meaning they have to buy the shares back in the open market, regardless of price, to limit their losses.
And that forced buying just amplifies the upward movement.
It adds fuel to the fire.
So the analysis interprets that initial plus 3.77% move to $11 as potentially the beginning of that pressure building. It could turn the breakout into a mechanism for an even higher rally fueled by shorts needing to exit.
That's correct. It adds a mechanical tailwind to the fundamental case. It suggests the market structure is primed to accelerate any good news.
Okay, so we have the technical confirmation holding $11. We have the specialized business model driving high-quality revenue growth and the market structure for a potential massive squeeze. So what does this all mean for the actual stock price? Let's shift focus now to the future projections laid out in this analysis report.
Understanding the analyst targets here, it requires distinguishing between the immediate technical hurdles and the long-term fundamental potential. It gives you a clear roadmap of resistance levels.
In the short term, the analysis is looking for immediate clearance of $11.30. That was yesterday's resistance high.
Right.
If the stock can decisively clear and hold that level, the technical path to $12.50 is considered wide open. That's the immediate benchmark for momentum traders.
Then, moving out slightly, we get to the average analyst consensus. The report cites an average target across the strait sitting around $14.25.
Okay, so that $14.25 mark represents a potential, 29% upside from the current $11 level? That's a strong baseline return expectation.
It is. But of course, the part that generates all the excitement and the highest risk is what the analysis calls the Super Bowl case. This is the scenario that drives the highest projected outcome.
And according to this analysis, the highest street targets for SOUN go all the way up to $22.85.
A figure like $22.85, which is a potential 100% gainer from current levels. That's only possible if specific fundamental events accelerate. And this is where we need to be really clear about the risk. This highest target is entirely contingent on the automotive backlog converting to recognized revenue faster than the market currently expects.
Let's pause there, because for you listening, the difference between backlog and recognized revenue is crucial to understanding this. Can you define those terms for us?
Absolutely. Backlog revenue is revenue that the company has contracted for money that's been promised by clients like Stellantis, locked in by multi-year agreements. But the company hasn't actually delivered the full service or product yet, so they haven't earned it in an accounting sense.
Okay.
Recognized revenue, conversely, is money that has actually been earned and recorded on the income statement after delivery.
So the company is sitting on a mountain of contracted future revenue, the backlog.
Huh.
The $14.25 consensus assumes that backlog converts to earned, recognized revenue at a kind of standard, steady pace.
Correct. The $22.85 target, that 100% gainer scenario, is only achieved if the pace of delivery, the pace at which those voice AI units get installed in cars or those restaurant rollouts are completed, happens much faster than anticipated.
I see.
That timing is the single largest variable determining whether SoundHound can hit that extreme high target.
That provides vital context. So the analysis is based on performance contingency, not a guarantee. You're not just betting on the tech, you're betting on the speed of implementation of these massive industrial contracts.
Precisely. If that rollout or conversion slows down, those high targets become much harder to reach, and you introduce the risk that the high short interest could be proven right.
This has been a tremendously insightful deep dive into a very specific and high volatility name. To summarize the core conclusion of this analysis report, SOUN held the $11 line, suggesting a technical reversal is underway. It's driven by high institutional conviction and a short squeeze mechanism.
And fundamentally, the specialization moat their expertise in difficult commercial voice environments is securing major sticky contracts. This is reflected in that strong revenue growth of 68% year over year, which suggests the commercialization phase is really hitting its stride.
And the report lays out a clear path for significant upside,
provided the execution on that automotive backlog accelerates.
And as we always stress, this deep dive is an analysis of a highly bullish report focusing on a specific stock. It is not investment advice, but rather a guide for you to understand the arguments driving market momentum in the niche AI sector. It's imperative that you consider the risks associated with dependency on that automotive backlog conversion and the potential for a slow rollout.
That dependence is the key variable to watch. It is the hinge upon which that $22.85 target swings.
That said, this whole story raises a massive question for reflection that applies to the entire tech landscape right now. If specialized AI, like speech-to-meaning, can achieve these massive multi-year locked-in contracts in vertical, difficult commercial markets like automotive and restaurants, does the future of AI investment truly lie in these focused niche experts who own a specific commercial application?
Or is the long-term money still solely dependent on the generalized power and massive scale of the foundational large language models?
There's something to mull over as you watch the AI sector heat up. Thank you for joining us on the